All right, so picture this. You've done it. You've found the perfect house, you put in an offer, and the lender just said the magic words. You're approved for a mortgage. It's this huge, incredible moment, right? But I've got to tell you something really important. The race isn't over. Not even close. You've just entered the final and honestly the most delicate lap.
See, that loan approval, it's not a guarantee. Think of it more like a conditional yes. It's like a snapshot of your finances taken on one specific day. And from this very moment until you have those keys in your hand, well, you're in this critical waiting period where every single financial move you make is under a microscope. And that's where the real danger is. There's this handful of unwritten rules, a set of commandments, if you will, that are protecting your loan approval. And breaking just one of them, even by accident, can cause some serious delays. Or worst case scenario, it could kill the deal entirely right before you get to the closing table. So the big question is, what are these rules? How do you actually get through this period safely and make sure you cross that finish line without any drama? Well, that's exactly what we're going to break down right now.
Okay, I know, that's a lot to take in. To make it way easier to manage, we're going to break all of these down into 3 simple categories. Everything that has to do with your credit, your money, and your debt.
Let's kick things off with the first category, protecting your credit. I mean, your credit score and your history are what got you approved in the first place, right? So your number one job right now is to keep them rock solid.
And the first and honestly the most important rule is this: do not open any new lines of credit. I get it. It's so tempting to apply for that department store card to get a discount on a new fridge for the house, but you have got to resist the urge.
So why is this such a huge deal? Well, it all comes down to this thing right here, your debt-to-income ratio, or DTI. Your lender approved you because your income and your debts were in this perfect balance. Any new loan, no matter how small, adds more weight to the debt side of the scale, and it can tip that balance, possibly pushing you right out of the approval zone.
Now, this next one is all about consistency. While you shouldn't be adding any new debt, you've also got to manage the debt you already have perfectly. Do not miss or be late on any payments. I'm talking car payments, student loans, not even one single credit card bill.
And you can see exactly how a lender sees this. It's totally black and white. When you make consistent on-time payments, you look reliable, you're trustworthy. But a single late payment, especially right before closing, that shoots up a massive red flag that says you might be a financial risk. And finally, for this section, please do not co-sign a loan for anyone. It doesn't matter if you're just trying to help your cousin get a new car. When you co-sign, in the eyes of your lender, that debt legally becomes your debt. It gets added straight to your DTI, and it can put your own mortgage in jeopardy just like that. Okay, moving on to part 2, your money. This section is all about keeping your income and the cash you've got in the bank totally stable. Lenders want to see a financial picture that is predictable, no surprises. The absolute biggest rule here is don't change jobs. Seriously, even if it's a better job for more pay, any change in your employment creates uncertainty for the lender. They really value that consistent 2-year history, and a brand new job, especially if it changes how you get paid, like from salary to commission, can send your loan right back to square one. And this isn't something they just check once at the beginning. Oh no. Lenders do a final employment verification, and sometimes they do it on the very day you're supposed to close. If they call and find out you suddenly left your job, the loan stops dead in its tracks. This next one, I know, it feels a little backwards. Don't deposit large chunks of cash into your bank account. It might seem like having more money is a good thing, but here's the deal. Federal regulations mean lenders have to be able to source every single dollar you're using for your down payment. A big untraceable cash deposit is a huge red flag for them. And that leads us to the one do on our list. Keep saving money. Lenders don't just want to see that you can afford the down payment. They want to see that you'll have cash reserves, money left over, after you close. It shows them you can handle any unexpected expenses without missing a mortgage payment down the road. All right, let's tackle our final category, how to manage your debt during this critical time. This is where a lot of buyers make really simple but very costly mistakes.
So the big one here, just hold off on any major finance purchases. Don't go buy a new car. Don't finance a whole new living room set. Don't get that new washer and dryer. Yet. All of those things add a new monthly payment, and you guessed it, it's going to mess up that DTI ratio we talked about.
And it's so easy to think, what's the big deal? It's just a few $100 a month for a new sofa.
But that's the whole point. Your loan approval is a precision instrument. Even a tiny change of a couple $100s can be enough to tip those scales and put your entire approval at risk. Now for our last and probably most surprising rule. Do not suddenly pay off old collection accounts. I know, it sounds like the responsible thing to do, but here's the catch. A paid collection is still a collection, and when you pay it off, it can update the last activity date on your credit report. And that fresh activity on an old negative item can actually cause a temporary dip in your score, which is the exact opposite of what you want right before closing.
So we've covered a whole lot of don'ts, but if you only remember one thing from all of this, let it be this one. The single most important rule that really governs all the others. This is it. This is the golden rule. When you are in doubt, call your loan officer. Thinking about maybe changing jobs? Ask your lender first. Getting a big cash gift from a relative for the down payment? Ask your lender how to handle it. Your lender is your partner in this. They want you to succeed, but they can only help you if you communicate with them before you make a move. So just remember that metaphor from the beginning. Your loan approval is a perfect snapshot of your financial life. Your one and only job between now and closing day is to keep that picture exactly the same. Don't change the lighting, don't change the background, don't even change your pose. Just keep things still. By following these commandments, you're not just dodging mistakes, you're taking control of the whole process. You're ensuring a smooth path to getting those keys. You've come this far, and now you have everything you need to know to get across that finish line.